This is Dream Chasers, episode 20, with jroll. Hey guys, what's going on? I'm Adam Carswell, and welcome to Dream Chasers, Interviews with the Future. On Dream Chasers, we interview individuals with supernatural amounts of potential based on early success in their careers. Thank you for tuning in. Now let's get straight to the interview. Hey guys, this is Adam Carswell, and today I'm joined by jroll. Jeremy is a full-time passive cash flow investor that focuses on real estate. He's originally from Montreal, Canada, and currently resides on the other side of North America in West LA, the Beverly Hills area. Jeremy, thanks for being on the show. And do you have any opening remarks for our listeners?
Yeah, thanks so much for having me. Really appreciate it. Hopefully this will be, informative for the listeners. So I guess just to expand on that, I am a full-time passive cash flow investor. I've been investing in cash flow opportunities, mostly in real estate and mostly in commercial real estate for about 11 and a half years full-time, but for about 17 years now. And, cash flow really changed my life. It actually got me out of the corporate world. And we can get into all that if you like, but I used to work, Toyota headquarters, Disney headquarters here in LA. So I worked for some big companies. I have an MBA from the Wharton School, so I was really on the typical corporate track, and cash flow just truly changed my life, and that's my primary focus right now.
Absolutely, and it's really nice to have Jeremy on this show because he brings a different perspective. Normally, I have individuals who are pretty young in their career or new to their industry that are shaking it up and doing big things. As he just mentioned, he's been doing what he's doing for quite some time now, but he's going to be able to still provide some futuristic, or at least I would like to consider futuristic insights that we can all use as we're chasing our dreams over the next few years. I also want to make a note that I know Jeremy through one of my good friends and business partners, Hunter Thompson, and Hunter, who's the managing principal with Cash Flow Connections based out of LA, has always had great things to say about Jeremy, really looks at him as a mentor. So Jeremy, it's great to have you on here because it's kind of like I'm interviewing my grandpa mentor now.
Yeah, that's funny. People say that I look younger than I am. I think I'm about 45, but I look 35. So no one's ever called me grandpa, but there's always going to be a first. So.
All right, nice. Yeah, I mean, in a good way, right?
Yes, absolutely.
So Jeremy, how long have you, I know you just mentioned it, but can you kind of describe how long you've been in the industry you're in right now? Passive cash flow?
Sure, yes. Yeah. So I have been focused on passive cash flow since 2002. And in fact, I got into it in 2001, started to research it based on the dot-com crash that happened. I'm not sure if everybody who's listening really even remembers that time, but that was the stock market crash. And the reason why I got into passive cash flow, and it was really for predictability. So when I was working in the corporate world, I was trying to save for retirement like everybody else is. And after the dot-com crash, I was really fed up with the stock market for two reasons. One was the volatility, because I'm a really, really low risk guy. So watching it go up and down 30% in a year just was not for me. But actually, the more important reason that really bothered me even more was actually the lack of predictability. So not knowing where my retirement account would be in a year, 10 years, 20 years, that actually bothered me the most. And I realized it just wasn't the right fit for me. So I was looking for different ways to invest that were a better fit. And really what I ended up realizing is I was looking for more predictability. And so that's how I came across cash flow and passive cash flow. And I actually went on the passive side because I was way too busy while I was working. This was at Disney headquarters to do an active, very busy job. And so that's how I started in the passive cash flow path. And I eventually rotated all my money out of stocks and bonds into passive cash flow, which eventually got me out of the corporate world. So that's how it all got started.
During that time frame at Disney, is that when you say that you realized you wanted to take this to the next level, or was there another defining moment?
No, that was it. I mean, the real catalyst was the stock market crash, dot-com crash, but that was right around the time. And it was right back then.
Very interesting. So speaking of crashes, what direction in the next 3 to 5 years do you see our real estate market in the U.S. heading? I know even for myself right now, it feels like it's been expanding and prospering all over the map. And so I'm starting to see a few things right now that are concerning me, but I don't know if it's going to be another 2008. So next 3 to 5 years, where do you see our market heading?
Yeah, great question. So just to start, I invest in commercial real estate primarily, and also some residential real estate, and also a whole bunch of things that are not real estate related, but I focus mostly on commercial real estate. On the commercial real estate side, my personal opinion, I'm not a financial advisor or an investment advisor, so nothing I'm sharing just my opinion as an investor, but my personal opinion is that we're really right at the top of values based on the cap rate. So meaning the multiples of net operating income just seem, in some cases, outlandish to me, and just don't even make sense. So I think that we're looking for some type of adjustment here, probably in the next 1 to 3 years on the commercial real estate side. On the residential real estate side, I think it's a little trickier. I know a lot of media has had a lot of coverage recently about, the whole market, the single family market slowing down. But what seems apparent to me is that in some places, affordability is way off the charts. I'll give you some examples like Seattle and San Francisco. And I don't mean to single out those, just ones that come into mind. There's others too. Denver. In other markets, like in fact in LA, which is very expensive, but in California, let's say, generalizing, it's very expensive as it always is. Mm-hmm. But from an affordability perspective, we're not matching the relative affordability challenge in terms of what we peaked at in 2007. And so will we get there before there's a downturn? I don't know. If we don't, it would probably be because it won't be quite as euphoric as it was before. The lending won't quite be as loose as it was before. And so what that means, though, is that if you look just kind of, you're a chart guy, if you're not hitting the same peak, you're typically not going to fall as much. Now, there's all types of variables to that. It's a very big generalization. But so I'm expecting that some markets will have a pretty major correction or adjustment on the single family side. Some markets not quite as much. I feel like with commercial real estate, though, everything is kind of like the tide has brought everything up across all the asset classes. And I actually invest across a lot of different asset classes on commercial real estate. And we can, everything's location specific. That's the way real estate works. But so everything I'm saying is generalization. And of course, there's different classes of assets. So in other words, there's Class A, Class B, Class C on commercial. So we can get into those too. But those are my high level thoughts, across everything.
So is this a time that you see as a really prime opportunity to start gearing up for acquisitions?
I am waiting for that time, but that time is not here yet. And the other thing I'll say too is that real estate tends to go much more slowly as far as price adjustment than stock markets. The stock market can go down, like last week, I think it was down. I don't know how many percentage it went down last week, but over the course of several days, it was down quite a lot. Whereas in the way that real estate works is that it goes slowly. So it's almost like, sellers want to sell for a certain price, buyers want to pay a certain price, and eventually that gap widens. There's a stalemate, and eventually the sellers will capitulate if it's more of a buyer's market. But that shift takes a long time. So I would caution anybody that if you're seeing a market start to turn down and you think it's going to be a proper downturn, you got to be really careful not to go in right away. I actually know a number of hard money lenders in 2008 and 9 who were people that give loans for home flips in California who started to lend once things started to go down in the secondary markets here. A year later, they were bankrupt because they were trying to catch a falling knife, and essentially, what they thought a 20 or 30% price cushion would be good enough. Well, a year later, those prices were down 40% and they were done, right? So, it's funny because if you want to optimize things in real estate and in general, you want to buy when it's starting to go up again because then for sure you're done. There's typically not double dips in general cycles. And so the safest thing to do is to wait till prices go down and start to come up again. But if you really want to catch at the right time, typically you either want to get a really unique deal at the time it starts to go down, or 1 to 2 years in is when you can start to really go in. So, so I will be looking very aggressively once there is a beginning of a true downturn and proper adjustments and multiples. But I won't be like rushing in the first day. I'll probably be starting to rush in the first year or two.
Interesting. So, for example, I'd say if that downturn comes, what are certain markets that you would even be concerned about? For example, if there's a good deal there now and a good deal there in 2 to 3 years, like what markets do you feel are basically recession proof? Or should I say even asset classes?
Yeah. So first of all, for markets, I don't really think anything is recession proof, so to speak, because realistically, there will be adjustments in every market in employment. No matter how strong a market is, they're going to probably be felt by a true economic recession will hit everything. But what I will say, for example, is markets that don't have as much of a run-up typically don't have as much of an adjustment down. So that could be, let's say, some specific Midwest cities that just don't typically have the same run-up. Historically, Texas didn't have much of a housing run-up and they wouldn't get much of a downturn. This time it's a little bit different. But, the more historical Texas type of markets, those are the ones that are less susceptible to downturn. In my opinion, in commercial real estate, so that's in residential. In commercial, I believe that in the vast majority of markets have had multiple run-ups. I've seen a couple that aren't quite as bad as others, but even those will adjust. And by the way, one of the reasons why they'll adjust is because interest rates have been going up, and part of the multiple or the cap rate that's involved actually is takes into account the interest rate. So I don't think anything is completely immune, but I do think that any market that hasn't as much of a run-up, you can kind of assume that will probably have less of a probability of having as bad of a downturn. Now, as far as asset classes go, that's a different story. If you're thinking of stability of cash flow, there are certain asset classes I think they will do better than others in the downturn. If you're thinking of actual asset pricing, I think that that's going to be challenging across most of the asset classes, given where the multiples have gone this time. So I'm not sure which one you had in mind for that question. Was it the cash flow?
I would say for cash flow.
Yeah. So for cash flow, I'll give you a couple of examples of stuff that tends to do well in downturns historically. So apartments, okay, the rents tend to be pretty sticky in most places. Of course, if there's a ton of overbuilding, or if there's been a huge run-up, if it's a very volatile apartment market in terms of rents, or if there's been a huge run-up, then you can expect more of a downturn. But in most major markets, where there isn't crazy overbuilding and there hasn't been an insane run-up in rent, then those are going to have maybe be less susceptible. They may adjust a little bit, but they won't adjust as much as, example, an office building, on average. Again, I'm making generalizations, but mobile home parks, rents have definitely come up a lot in that space, but I think it's kind of one of the last bastions of having affordable housing. I think that they're going to be less susceptible on average to rent adjustments down during a downturn. Self-storage historically has done very well during a downturn. It's one of the reasons why I like that asset class just defensively. I think that the multiples and cap rates are very out of whack at the moment, but I think if you want stability of cash flow, I think that that will be an interesting asset class to protect. Now, self-storage is tricky because it's very low barrier in terms of cost of entry to build. So if you're in a market with oversupply, that could definitely take rents down. But putting that aside during a downturn, self-storage could be good too. There's a lot of other things like senior living, for example. Depending on whether it's public pay or private pay and what type of senior living it is, some of the subclasses of senior living that are more private pay, where there's a short supply and people are paying out of pocket, well, those seniors still have to live there. And when areas they can afford it, the downturn is probably not going to affect them that much if you're at the right household income. So senior living is going to have a lot of demand over the next decade plus based on the aging population. But again, part of the challenge with that asset class is there's actually always been overbuilding in some areas in that asset class. And so you've got to be careful with the supply and demand features of a specific market. So those are just some examples coming to mind right away.
Yeah, no, thank you. That's some very valuable insight. And I'd say when it does come to recession, based on what you just said about pricing, ideally being in a good cash flow position seems like that would be ideal for another downturn. Tying into that also, do you have a basic philosophy that you follow when positioning your portfolio for the good and the bad times?
Well, so it's interesting. The way that I invest, because I'm low risk, I tend to have to think many years ahead. So, I typically like to, because I look for predictability, I typically like it to get into a deal that's got a 10-year loan, which is kind of the more common longer-term loan in commercial real estate. And I like to be in a fixed rate interest rate so that we kind of have that predictability. So assuming you're investing in a 10-year fixed interest rate commercial real estate type of opportunity, you got to think way ahead, right? So if you're locking yourself in for 10 years, or locking in is probably the long term, but if your business plan is to be in that opportunity for 10 years, barring any reason to sell or get out, then you got to think years ahead. So I have been investing for what I call a downturn in terms of defensively since 2013, thinking that we would have a downturn around 2018, which was clearly wrong, and positioning myself to be in the right asset classes as of 2013 so that I can weather a downturn and not have to worry about it as much. You have to think way ahead on the commercial real estate side if you're getting into longer term deals. It's pretty tricky. Right.
What industry leaders and role models are you inspired by? Who do you follow? I know you mentioned earlier, even keeping up with the media. What's your preferred media source? I know I just threw like 3 questions at you there, but can you enlighten us on that?
Sure. Yeah. So first thing I'll say is, if you're, in my opinion, if I'm trying to understand what's really going on in the market on the commercial real estate side, I love Sam Zell, and I like him for 2 reasons. One is because he just tells it like it is. And I love hearing his real thoughts as opposed to kind of being politically correct or having to worry about what is said on behalf of a public company or whatever it is. And number two is I find he's just brilliant in understanding the cycle. So if Sam Zell is selling his entire apartment portfolio tomorrow, that's something to seriously consider as to why he's doing it, in my opinion. He just seems to be a brilliant timing person and really understands the market. So that's one person. I mean, there's definitely other people too, but he's the first one that comes to mind. Mm-hmm. On the media side, I would say that, I actually straddle two parts of the fence for the way I track data, because I actually read probably an hour or two a day of data to really understand what is going on out there, and it's really to get out of the weeds of the media. But on the one hand, I look at data, and there's some really good sources for that. So one website I really like, but it's very negative. So if you could kind of put out, just kind of ignore the negativity and maybe half the articles that just are a bit extreme. I really like Zero Hedge. These are former Wall Street guys that have a ton of charts. And so if you want to just, kind of make of what you want of those charts, it's a really good place to see a lot of charts. CalculatorRiskBlog.com is also really good for those charts. As far as, so I kind of follow, a few different websites for that, but then I also want to track consumer sentiment. And so what I do is I have to look at the mainstream media to understand what the consumers are reading. So right now, for example, I've watched the mainstream media in the past couple of months really turn down on housing. That is going to affect consumer sentiment. And real estate is definitely sentiment based in many ways, especially on the residential side. Mm-hmm. So I think that, with the media coverage starting to talk about a housing downturn, it's almost like making it happen in people's minds, or people who weren't as familiar that it is happening, they think it's happening. So I definitely track that carefully, and also watch the stock market and see where it is and the sentiment behind it. So I look at CNBC for some of the raw data. I look at Drudge Report just for like a quick overview of in general, what are consumers reading. Same goes for Business Insider, what is kind of being fed to consumers, so to speak, and a few others. And so I kind of get an idea of, okay, I don't necessarily pay attention to that as much, but what it tells, because I'm a very high level thinker, it tells me okay, what is really going on high level that the consumers are probably thinking, and then what's the data saying? And there's a huge difference between the two sometimes. And the data can let you kind of think a step ahead, while the media kind of allows you to understand what a consumer is thinking today. And so I like blending the two to kind of get an overall sense of what's going on now and maybe where things are going at the same time.
Right. I really like that. I've never really taken into consideration the consumer sentiment approach. I like that because sometimes when you are watching the general news, general media channels, it's easy to kind of just throw it in the category as, fake news, as some people like to say. But when you take a look at it from how are the consumers responding to this and taking that high level approach, I think that's really beneficial. And then also just to recap, you said Zero Hedge and Sam Zell were the two other sources you really like?
Yeah, well, Sam Zell, just in terms of who do I look at as an individual to understand what's going on in the market and just to tell like it is type of scenario. He's great. Zero Hedge is probably my favorite just for general charts and watching the stock market, housing, and other things, but to be able to get access to a lot of charts, as well as Calculator Risk Blog is just kind of more of Calculator Risk Blog is more of a positive slant, and then Zero Hedge is a negative slant. Calculator Risk Blog republishes a lot of current data that's released by the government, so you can kind of get a sense of some of the charts as well as Zero Hedge.
Perfect. So what advice do you have for aspiring passive cash flow investors, maybe, someone who's in your shoes back in 2003, and can you give an example of something that you wish you would have done differently?
So I think the number one thing when it comes to passive cash flow investing is your network. I like to tell people that I think every deal I've ever invested in, there is some type of network component in terms of how I found it, because most of those opportunities are not allowed to be publicly marketed. That's changed since 2012 with some new laws that were passed, but I still hold to the fact that most of them are probably still private from what I see. So you have to go network to find those private opportunities, and not allowed to publicly solicit investors. So networking is absolutely key if you want to get access to a lot of really good passive cash flow opportunities. If you are willing to kind of deal with an intermediary, so if you want to get a lot of access to deals, but you're willing to have an intermediary take a small slice of the pie in exchange for finding and vetting opportunities for you, some of the crowdfunding sites like Realty Mogul and Realty Shares and some others can be good resources. Just keep in mind that they're going to be they're a business, and they're in the business of helping you to find opportunities, but they're going to get a cut in exchange for it. So the return is a little bit lower. But if you don't have time to network, I think those are fantastic resources that didn't exist when I was starting. And so I think you could look at either or both of those sides. As far as, what would I do differently or, when I was starting, the number one thing I always say is I wish I would have started sooner. I actually started, I think, down this path when I was 28. I've got to really, I'm not 100% sure that's accurate, but I think it is. And while that seems like it's decently young, I think that because of the compounding and snowball effect of investing in general, and especially this type of focus on the cash flow, where I'm trying to build this bigger and bigger cash flow snowball over time, the earlier, the better. So had I started putting money into cash flow instead of the stock market years before the dot-com crash, I would have potentially been in a better place today just because I would have started sooner. I just would say that the sooner you're able to start, if you're interested in the path, the better. And if you're thinking about the path, I would say also that today I consider it a very dangerous time, both on a residential and commercial, to invest because valuations are very high across all the assets in both of those categories. So it's actually probably one of the best times to learn because you're not really missing out on much given the pricing. I definitely recommend that don't go down these paths or this passive cash flow path until you fully understand, have had a good learning, and understand exactly what you're investing in. And I think that could take some time. And that while, eventually you're going to want to dip your toe in the water, I would say don't rush in, especially right now. I consider it a very dangerous time to invest from a price perspective. So again, it's a great time to learn.
Awesome. Yeah, thanks for sharing that because that helps. I know that helps me too as I'm still in my early years of just learning how this industry works. So I appreciate that. And then also tying into networking, you are a part of a pretty prominent, I would say, investor networking group, Phoebe, for investors by investors. Can you tell us a little bit about how you started that or how you got involved?
Sure, yeah. So for investors by investors, or Phoebe, or FIBI, that's a nonprofit that I started with one other partner in 2007. And so how that came about is between 2002 and 2007, when I started on this cash flow path, I had to network to find opportunities. The crowdfunding websites didn't exist, so that wasn't the only choice I had. So I'd probably go to 1 to 3 investor meetings a week in person in Los Angeles, a lot of different real estate meetings here. And the problem with some of those meetings is that some of them are really kind of hardcore sales pitches. And when I went to those, the only benefit I would try to get out of that meeting, or the goal I would have, is to network with people at the end, because some of them, despite the fact that they were kind of pure sales pitches, actually, drew a pretty large critical mass of people. I mean, there was one in LA I remember specifically that would maybe have literally 300-400 people there, each month. And so what I would do is I would sit in the back row, bring work, both my phone and actual physical papers and file folders, sit in the last row, do work for 2 hours, and then network with people at the end. So I wouldn't pay any attention to the sales pitch, but I would network with people at the end. So what happened is that first meeting I went to after I left the corp world from the cash flow, I was literally sitting in this pitch meeting, sales pitch, and I said, oh man, what am I getting? Like, I don't have any work. So now I have to listen to this 2-hour sales pitch. So we started FIBI as the answer to, like, where can you go to a meeting without a sales pitch? And I said to myself, why waste 2 hours at this meeting? I can actually run my own meeting for the same 2 hours, right? And then network with people and actually tailor the topics and everything else. And so we started out back in 2007. The goal was to break even on the cost of the venue and to hopefully, unite enough investors and really, learn from each other, exchange information, network. We grew organically when people saw that we were for real in terms of the really hardcore no sales pitch foundation. And long story short is, fast forward 10 years, 11 years, and we became the largest series of public non-institutional real estate meetings in California, thanks to meetup.com and just the organic growth because of the fact that we don't do a hardcore no sales pitch. So we have I don't know the exact number, but we have over 27,000 registered users. And you can find us on meetup.com if you type in FIBI or for investors by investors. Most of our meetings are in Southern California, and we've kept it very local because we are also very hardcore on not taking on any chapter leaders unless we've known them literally for years. We know the real estate experts, and we have no concern that they're not going to sell. So that's why we haven't expanded to other states really very much. We're in a couple other states, but only with people maybe we knew before who left here and then opened chapters there that we know very well. So we have several chapters that are active right now. We have some that are dormant because it's hard for us to find replacement chapter leaders when somebody steps down because we have to know them really well with the no sales pitch and their knowledge base. But hopefully those meetings will be helpful. We've had many great meetings, and it's been a great thing. We actually lose money off of it every single year, but from our perspective, it's completely worth it. And the networking from that alone has just changed my life. I've been very lucky because I'm kind of like one of the two co-founders, so I get a lot of visibility. I'm kind of the hub of the network, and so my network really exploded after that kind of grew.
Yeah, that's a super valid explanation of the power of networking. Because honestly, if it wasn't for Phoebe, then I don't know exactly how you met Hunter, but I would assume it was through FIBI, and that's how we're having this interview.
Yeah, that's a great question. I would say that odds are that that's the case. I don't remember it for sure, but it's more likely than not that that's how that happened.
So your network is your net worth. All right, I've got 3 fun questions just about Jeremy, so we can all get to know a little bit more about who you are as a daily person. The first one is, what is your favorite city? The second one is, what is your favorite candy bar? And the third one is, what is your favorite color? And you can go ahead and answer those in any order you like.
Okay. All right. So let's go with the easier ones first. So candy bar, I hardly ever eat candy bars. I used to eat them when I was younger, but it's been a while. The one that comes to mind, which is going to be really odd to some listeners, because I think it's something you can buy mostly in Canada, although surprisingly I saw it's local 7-Eleven here recently, because it's Cadbury, which is not a company that's been in the U.S. very much. It's actually chocolate it's from Europe.
I think it's, yeah.
Yeah. So it's a chocolate bar called Crunchy, which if you've never tried, I don't know how to describe it. It's just very unique. And if you ever see it, just buy it and try it once. Really, really good. They put something in the middle. It's crunchy in the middle, chocolate around the outside. I think it's like honeycomb or something, but it's just really, really good. As far as color, in general, my favorite color is probably blue. I'm a car guy, and my favorite color on cars is typically gray or black, and I'm a bigger fan of gray or more like a silver gray. When it comes to favorite city, that's much harder. I'm going to give you a few favorite cities. So I really love Montreal, where I'm from, for many reasons. It's a great city, kind of a European, but also North American mix. It's very unusual. Mm-hmm. Really great to visit in the summer. If you've never been there, I highly recommend it. Love Chicago in the summer. Just amazing city. Similar to New York, but smaller, but same feel, and just really, really great as a tourist. Love Manhattan, especially as a tourist. And it's so much fun. I've got younger kids. If you're able to take your younger kids and walk around Manhattan, it's probably an amazing experience for them, given the number of buildings and just so much to do. Just a great city with so much energy. Really like LA, where I live too, and other cities as well. So I will say this also. I've been to Aruba many times from the past, and I happen to love. That's really actually a country, but I love it there as well. So I have a lot of different cities I could talk about.
Yeah, they're all pretty big cities, pretty major cities. So I guess Aruba can kind of be like the diamond in the rough.
Yeah, exactly. And Aruba's kind of a little off the charts. Aruba, for those of you who don't know, is a tiny island. I mean, when you're landing on it, I forget the exact dimensions. I feel like it's 10 miles by 6 miles, but I could be wrong about that. I think it's like 60, 70 square miles. But, if you're at the right altitude, you can see the whole thing under you. So definitely not on the biggest city side, but very different and a great place to vacation, obviously.
Nice. Yeah, I haven't been there yet, but it's definitely on my list now. Is there any way that the listeners can contact you after listening? Yeah,
the easiest way to reach me is through email. So if anybody is, if you're a past investor, you want to network, if you're new and maybe you just have questions, I'm happy to help anybody as much as I can. So if anyone interested in passive investing or doing passive investing or somehow related, I'm also interested in looking at opportunities. My email is jroll, JROLL, at Roll Investments, which is ROLL investments with an S, so plural.com. So jroll at rollinvestments.com. That's definitely the best way to reach me. Don't hesitate to reach out. I'm happy to really talk to anybody.
Perfect. Thank you. Thank you for being on the show today, Jeremy.
Yeah, thanks so much for having me on. Really, really appreciate it. And I hope that the information we talked about today is helpful for the listeners.
Everyone who's tuned in, we look forward to catching you in the next episode. And remember, in all you think, say, and do, take it to the next level.